Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mike Lee, Global Wealth and Asset Management Leader of EY, to discuss high net worth investing trends and how they approach different styles of investing and digital assets. Mike, it's great to have you with us. Welcome to Trade Talks.
Jill, thanks. Appreciate the opportunity to be here today.
You got it. How have volatile markets heightened demand for wealth management advice, such as from younger adults?
Well, tying to the research that we did, I think it's important to understand this is really a reflection of the voice of the customer and the ideas that we interviewed over 2,600 wealth management customers across all the traditional segments: wealth, generation, geographical. And we did this in October and November of 2022. So I think it's important to put that in context. But specifically to your question, really all age groups are seeking additional advice in response to volatility. However, millennials are actually seeking more advice, and really a 2x multiple compared to Gen X and almost a 3x multiple compared to boomers. And really it's the idea is that things just feel harder, both investing and wealth management. And it goes beyond just the complexity of the political and geopolitical economic environment that we've been operating in. It really ties back to kind of the rise of new investment products like digital assets and the continued democratization of private capital and alternatives, just the growing availability of online and hybrid offerings, and just the continued transition of the industry itself, the impact of fintechs, and in turn, what incumbents have done really to adapt their business models.
For the high net worth and ultra high net worth individual who feels unprepared to meet their financial goals, why do they feel this way? And how does age influence this? And then also, Mike, what constitutes someone who's high net worth or ultra high net worth? What are those barriers there?
Sure. I would say first, kind of the whole concept of financial preparedness is really correlated, not surprisingly, with age. And quite frankly, that preparation feels better and increases both with the wealth level and the age level. And so when you look at the very high net worth and the ultra high net worth, and in our research, those categories really represent those that have investable assets between like 5 and 30 million and above 30 million. So, quite wealthy. They actually do feel quite prepared. In many respects, it was well over 3/4 of the respondents felt in a good spot. However, when you get to the high net worth and the mass affluence, for those with really less than 5 million, that preparedness clearly was less. And when you look at it from a generational standpoint, not surprisingly, millennials still are feeling the most unprepared. And really it's driven by probably, I'll say, 3 primary reasons. One is around returns and just the overall uncertainty around investment returns. And I think you need to consider the context of millennials and when they began investing. And many times it was tied to and around, I'll call it the financial crisis. The second is really around their engagement interaction, and really that they're not meeting with their advisors as frequently to be able to either review their portfolio or adjust their goals. And the third is just around the broader holistic nature of their plan and understanding how accounts that may be beyond their primary provider really impact their financial plan.
Can you discuss the appetite for passive versus active investments among investors, and how do generational divides impact this?
Sure. I would say overall, millennials are more satisfied with both their active and their passive investments relative to Gen X and boomers. And the delta between active was much smaller than the delta with passive. But I think what's more interesting is really the movement to active investment, as well as to, I'll call it more defensive or safety measures into savings. And what we see here is that millennials are really twice as likely as boomers to take action around volatility. But when they move, they equally are moving to the active side, as well as to savings and deposits. So it's an interesting dichotomy, but the fact is that millennials are more apt to move. And when they do move, it's literally a 50-50 split between going more active versus actually going more defensive or safety into savings and deposits.
Given the current market environment, how are high net worth and ultra high net worth investors approaching digital assets? And how will investors approach digital assets in fintech companies in the coming years?
Sure. Let's first focus on the digital asset side. Clearly, there's an interest and a stronger interest, but there's also a need for both the customer as well as the advisor to better educate around these non-core asset classes, whether it's private capital again, or specifically digital assets. And I think there's an element here that is required whereby it should be a greater focus around, I'll say, the outcome versus just the return. Because I mentioned earlier some of the challenges that millennials have had in particular around understanding and their concern with return. So I think there's overall the industry needs to do more around better educating around these non-core asset classes. And what's interesting today, just over 10% of investors are, I'll say, engaging around the digital asset environment. We expect that to increase about 50% over the next 3 years. So call it 1 in 6, 1 in 7 being participatory around digital assets. But again, I think there's the need for greater education to help understand how they fit into a wealth management portfolio. From a fintech standpoint, we're really seeing some significant growth, and you need to put it in context. It's really on a lower base, but from when we did the research 2 years ago, it's literally increased 50% for those that are open to engage with fintech providers, so non-traditional providers. And their expectation over the next 3 years is for that to even double again. And I think that's just a reflection of the pandemic experience and the ability to be able to be more comfortable with digital tools and the acceptance of more virtual and hybrid, because that's another area that we saw is that greater acceptance around hybrid interaction, which allows more frequent interaction to help, again, elevate around some of the complexities that may be tied to, I'll say, digital interaction as well as digital assets overall and how they fit into a portfolio.
And finally, Mike, in your view, what are the most important takeaways from this report?
I think it's really a reflection around the voice of customer, okay, in the context of the need to have a greater tie to what the outcome is, a greater tie to engage more frequently, to be able to do it in a different way than has necessarily been done historically. And that, again, is in the context of using digital tools to be able to help accelerate that interaction. And ultimately, it's the need to truly personalize and come together. It's join me and do this together versus sometimes I'll say that portfolio construction, the wealth plan is more in the context of here's what we think you should do. Let's do it. More collaboration. How can we do this together so you feel part of that process, part of that ownership? So in times of volatility, that reaction, that human nature that says I may need to do something different, you'll have confidence in the plan. It may not feel the need to actually act as much as we've seen in the results of the research this particular time frame.
All right, Mike, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.